this video, we're going to be talking about how charitable remainder trusts work, and to make it easier, we're going to compare them to a very similar structure you may be more familiar with, the Individual Retirement Account, or IRA. We'll explain the similarities as well as some of the key differences, with the goal of helping you understand how a charitable remainder trust, or CRT, might fit into your financial. So let's get started. First things first, what is an IRA? An IRA, which stands for Individual Retirement Account, is a retirement savings account with tax benefits. It's created by the government to encourage people to better save for their retirement. The key benefit is that gains, or the increases in investment's value inside of an IRA, are not taxed until they're withdrawn from the IRA, even after the assets are sold. As a result, you can avoid taxes and use those saved tax dollars to reinvest more money and create more wealth over time due to the miracle of compound interest. But IRAs have some key limitations and drawbacks. Number one, you can only contribute $5,000 to $8,000 per year. And as a result, it's virtually impossible to contribute already appreciated assets like a small business, shares in a company, or crypto. In addition, with an IRA, you can't withdraw assets before you're 59 and a half without a penalty outside of a few exceptions. Like IRAs, charitable remainder trusts are also tax-exempt structures that allow you to defer the taxes you would otherwise owe on capital gains realized inside the trust and reinvest those tax savings to create more wealth for you in the future. On the other hand, with the charitable remainder trust, there's no limit on contributions. So if you have an asset that's worth $10 million, you're welcome to put it all in the trust and protect it from that upfront tax bill. Take those tax savings and reinvest it to create more wealth for you in the future. Now, in addition, with a charitable remainder trust, you're able to take distributions starting from the very first year instead of waiting till you're 59 and a half. But charitable remainder trusts limit those distributions to a percentage of trust assets each year. So on one hand, an IRA allows an unlimited amount of distributions after you turn 59 and a half. But on the other hand, a charitable remainder trust allows you to distribution starting from the first year, but those are limited to a percentage of trust assets each year. With the charitable remainder trust, you will have access to significant distributions and liquidity starting in the very first year of your trust. And you will be able to access as much as the full value of your assets in the trust over the course of the first 10 years, depending on how fast those trust assets grow. Now, let's take it back to kind of the core benefit of an IRA and charitable remainder trust. What is the benefit of deferring taxes on your investment gains? As an example, a 35-year-old who invests in a traditional IRA and grows her investment at 8% a year until she is 60 may increase her returns as much as 70% due to the benefits of tax deferral, compared to the gains if she would have invested that money in a taxable account. Charitable remainder trusts work very similarly, but they can have higher returns because the core benefit is the same. Your gains are tax deferred, but you can be more selective about your timing and which assets you can contribute. So you can choose to only contribute your highest taxable items or your highest appreciating items and choose when you contribute them to increase your tax returns, as well as have more control over when you take a distribution compared to an IRA. It's important to notice a key trade-off with charitable remainder trust that doesn't exist with an IRA. You are required to donate a portion of the charitable remainder trust value at the end of the trust term to a charitable organization. This is where the name Charitable Remainder Trust comes from. The remainder at the end of the trust term is donated to charity. For some people, this is an additional benefit, as they like the idea of contributing to a charitable entity and doing good in the world. For others of you who that may not be a benefit, it is something you can price in. The government gives you an upfront charitable deduction that you can use to write off your taxable income today that they see as equivalent to the future value of the donation you're giving at the end of the trust term. In addition, for most highly appreciated assets, even after accounting for the charitable donation, you will still have more wealth in your name by using a charitable remainder trust compared to not using it. Alright, that wraps it up. Hope you enjoyed the video. If you have any questions, recommendations, or comments for the next video, please let us know in the comment section below. And please like, share, and subscribe so that you can learn more about all types of tax savings opportunity and other wealth building opportunities. Now, if you want to learn more consultation with one of our specialists, or simply use one of our easy-to-use calculators to estimate your tax savings, simply visit our website at valor.io to connect with us. And now a quick word about Valor. We built a platform to give everyone access to the same tax and wealth building tools billionaires like Facebook founder Mark Zuckerberg and others use. We make it seamless to pick the best strategy, set up and administer these structures all at a fraction of the cost of competitors. Please like and subscribe this video and our channel to learn more.